Hello, everybody. Welcome to another evening here at TF Labs, where we are going to be talking about the recent banking crisis. I'm really excited for today. We have a great audience here, folks. It's a beautiful sunny day in Seattle. If you're watching this online, feel free to ask questions in the chat, and we'll let you. We'll answer those questions. And then last is, if you're here, of course, we'll have questions here shortly that you can offer to our amazing speakers. So with that, I'm going to go ahead and introduce our amazing folks. And so first, let's go. Who wants to sit next to me? Joseph Vincent, please come on down. Give Joseph a big round of applause. Joseph Vincent is, oh my goodness, you ruined the camera. We'll fix it. Damn it. All right, I'll introduce Ivan while we do that. Next, we got Ivan. Ivan, come on down from Savings. Oh, good. I'll fix it. All right, Ivan. And last, we have Renata. Welcome, Renata. Come on down. All right, so we're going to need to improv here, and I need you all to hold this because I need to fix Joseph's thing. So when you introduce yourself,
my epic fail.
You get to introduce yourself like that. So I'm Jonathan G. Blanco, and you can see yourself there. So Joe, why don't you go in and introduce yourself real quick while I fix your camera?
Yeah, I'm Joe Vincent, and I'm Joe Vincent, and my background is I've been an attorney for 42 years here in the Seattle area. But I've also been general counsel for a couple of banks. In addition to that, I spent 18 years as general counsel for the Washington Department of Financial Institutions. I retired in 2021, and I do represent financial services companies here, and also people who want to get a bank charter or a non-depository license. Pleasure to be here. Oh, and in addition, I'm an adjunct law professor at Seattle U.
Awesome. All right, I'm Ivan Inchauste. I'm the Director of Finance and Capital Markets at Stably. My background is in traditional finance. I've done institutional investment management. Thank you. Are we? Okay. Institutional asset management, wealth management, and advisory, related to the investment business.
My name is Renata Fairbanks, and I'm a financial controller. I've worked with early stage startups my entire career, so for the last 10, 13 years. Right now, I specialize in Web3 businesses.
All right, fantastic. So we got it going. We're good now. So we are here in Seattle, and it seems like it's been pretty crazy over the last... Well, it's been pretty crazy for a while. It seems like every few weeks, every couple months, there's a new development. But obviously, the most recent development has been around Silicon Valley Bank, Silvergate. What's the other S one? Signature
Bank. And First Republic.
And now First Republic.
And Credit Suisse.
And Credit Suisse, right? It sounds like the theme here is you should have something governmental sounding or city sounding in your name to get rescued, right? So if you have like First Republic, or if you have Silicon Valley Bank, Silicon Valley or a place, Credit Suisse, right? Switzerland. So anybody who's out there who wants to start a bank, make sure that you put a city name or a country name so you can get saved. But what is going on? What's happening? Let's get a quick rundown of recent events.
Joe, you want to start off?
Yeah, I'll start off. Well, basically, you had a massive problem with Silicon Valley Bank. Well, let's start out with Silvergate Bank. Silvergate was heavily concentrated in taking the deposits of crypto companies. Okay. The reason is that there weren't a lot of banks doing it, and we'll get into that. Okay. That of course creates its own concentration risk if you basically tell other banks that, or passively aggressively tell other banks that they can't do it. you create a situation where only a few banks are doing it, you're going to have concentration risk. Okay. So Silvergate had those problems, and of course, that was Silvergate's problem. Silicon Valley Bank's problem was it wasn't in crypto at all. Basically, it did its banking relationships were venture capital firms and startups, and also heavily into health. What they had is they had a interest rate risk associated with the inverted yield curve that exists right now. They were heavily invested in, like the long bond, the 10-year mortgage bond, where their long-term investments in long-term bonds were at vastly lower interest rates than. Eventually, this was going to lead to a situation when this discovered, et cetera. You heard particularly when Peter Thiel sort of spread around Silicon Valley, get your money out. Then there became a massive withdrawal. In fact, $42 billion was withdrawn from Silicon Valley Bank in one day. Okay, and of course, when you have that kind of a run, you know that the Fed is going to step in. I should mention and that if you don't know, if you are a bank, you're all FDIC insured, but there are Fed member banks and there are non-Fed member banks. If you're a non-Fed member bank and you're a state charter, which Silicon Valley Bank was, your regulator is in California, is the state regulator. In this case, it was California regulator, plus the you would normally be the FDIC, but because they were a Fed member, their federal counterpart regulator was the Fed. So everything in relationship to a concern about how Silicon Valley Bank was being supervised or managed has to do with the Fed, because it was the Fed who was doing periodic examinations of Silicon Valley Bank. And then, of course, we had Signature Bank, which was heavily concentrated in taking the deposits of crypto companies, and they were told, "Hey, you can't do that anymore." And then finally, First Republic that had a similar situation. So I'll stop there, but that's just the lay of the land. And then finally, we have the issue of Credit Suisse. So we'll get into that. But there was this cascade of failures, mostly due to the deeply inverted yield curve, and also to, in some cases, improper management of interest rate risk, and in some cases, the fact of heavy concentrations in taking the deposits of crypto companies and then being told you just can't do that anymore.
Yeah, and that's a good point. Joe was saying like cascading failures. What we all know now and continue to relearn is that financial institutions are so interconnected that problems brewing in one bank or even a small subsection of banks that serve a particular industry can spread like wildfire. And that's like fundamentally what a bank does is they take deposits in from depositors that can remove those deposits pretty much on demand whenever they want when the bank's open. And then they lend that money or invest that money in longer term assets, whether it's mortgage-backed securities in the case of Silicon Valley Bank or loans to tech companies or what have you. And so there's a fundamental mismatch between assets and liabilities. And generally that's okay. And banks do they have whole risk departments that evaluate whether they have enough liquidity on their balance sheet to be able to handle depositors withdrawing the funds. What they don't usually solve for or manage is for bank runs of this level of magnitude that then get sort of amplified by social media, people that are very influential. You mentioned Peter Thiel. That's a good example of people that sort of add fuel to the fire. And so when you look at what banks fundamentally do, and if you look at these particular institutions that were involved with all of this, their deposits grew during a time when money was relatively cheap, meaning interest rates were low, and they had to invest that capital somewhere. And a lot of the time that capital was invested when interest rates were low, really, really low. Over time, as the Federal Reserve deemed it necessary to stem inflation, they started to increase interest rates to do so. And as a result, a lot of those investments that these banks essentially had on their books started to lose money in an unrealized fashion, meaning they hadn't necessarily sold them or sold a large portion of them. And so they're just sitting there on their books. And I think you have a background in accounting. So I'll let you talk about that. You're definitely way more qualified than I am to talk about that. But basically, they take massive losses, and then as depositors want their money on demand because they hear there's issues, or crypto is being attacked by the government, whatever ends up being the thing that scares people into essentially a bank run, they have to liquidate those assets for a fraction of the cost, or a pretty hefty haircut, and they don't have the money on hand to do that. And so then the regulators step in. FDIC sort of promises insurance, and even in this case, promising insurance to uninsured depositors. So,
yeah, well, I think we at some point should get into how it is that the uninsured depositors are going to get covered. But
yeah, and I think the accounting portion
today
of it, which you should definitely talk about, is really actually
I would like to add that SVB was helping to bank crypto adjacent companies, at least. I don't think that they were directly and I know this because I have clients that were using SVB.
But there wasn't a heavy concentration though.
And so whenever I hear like asset liabilities mismatch as an accountant, I'm like, oh gosh, this is another case of FTX. Are they using customer custody funds? But this wasn't the case. I think that we should kind of think of this in the sense, and I think Ivan was trying to touch on this point, is that the duration of time, there was an assets and liability duration mismatch. Yeah. So they can't liquidate their assets as quickly and match it to the customer deposits, which is viewed as liabilities on the balance sheet. Mm-hmm. So what I think is like kind of interesting though, from an automation perspective, is that, isn't it so funny that they didn't run these black swan scenarios of like a bank run happening and like not putting like some sort of stop or a blocker on like everybody withdrawing their cash. I mean, I think that's kind of like basic. So when I think about automation and banking, like whenever I onboard a new client, that's one of the first things that they want to do. They want everything to be automated, which is fine. But at the same time, we're not really thinking about risk profiles. We're not really considering, the operators behind these banking institutions. There was just so much trust in it. And now that I'm looking at this retrospectively, I'm like, how is this different than Bernie Madoff holding on to our funds, right? And this is kind of interesting that we might see a shift of, people realizing this. We don't have much trust in the economy anymore. We don't have much trust in the banking institution. So now people are kind of scrambling around, like, how do I preserve my assets? Because I can't carry around gold and go to a vendor and give them a gold bar and then like not think about them getting robbed. So I thought that was really interesting that, there weren't many stress tests performed.
Right. This is what's really interesting. I still contend that every time we have these financial crises, and what I try to teach is I go way back to the inception of the Federal Reserve, et cetera. And I typically take my students through all these different crises that have occurred. There's always a kernel of a problem that exists where a supposed cure to a specific crisis now is usually a setup in some way, shape, or form for the next crisis. So for instance, the last crisis we had, the 2008 financial crisis, was a huge credit and liquidity problem. Okay. All right. So, basically, you had toxic assets, you had loan portfolios that had severe problems, you had liquidity problems, et cetera. So what do the federal regulators do that supervise these banks? They heavily concentrate on that. They go out and they develop rulemaking for that. They develop standards for that, like Basel III, okay, things like that. These are all international standards too. So what happens, the banks will focus on that, but then sometimes they don't focus on what they should do, which is ask the what if to every aspect of the balance sheet, including but not limited to interest rate risk. Now, the Fed could have required that of them and made a bigger deal out of it. They did not. In fact, the Fed created the problem in a sense, because basically what they did is, they knew when they were going to hike up interest rates that this was going to pose a problem for banks. That wasn't heavily emphasized. So there is some major concern that there is a formal investigation going on now about where were the local examiners at the Federal Reserve Bank of San Francisco during this period. Okay. Because that could have been asked of, but like Renata said, the banks should have been doing this themselves. It's a base interest rate risk is a basic fundamental aspect of any bank balance sheet analysis. And so they should have been doing this themselves. Now, if they have a problem liquidating their assets, then that's a problem. But there was clearly an asset liability mismatch. They clearly were caught short because of a very, very different interest rate between their short-term borrowings and their long-term investments in the 10-year long bond.
Were they I guess playing into the system though, right? So because interest rates were so low for so long, and I don't want to speak for them because I don't know, but it's kind of like, hey, like I guess interest rates are going to be low for a while, so I might as well put it here. And then when the Fed does raise rates high quickly, like, is that even a consideration to the Fed as they're raising rates? Hey, sure, we should probably think about the banks that have put these short-term.
Well, if it impacts the banks might pull back on areas of their business, like providing loans, et cetera, and that actually would slow down business activity or economic growth. So it actually kind of does the thing they want to do. They just might do it a little too fast. I mean, it's like changes in monetary policy and even fiscal policy. It's not like one for one and not linear effects. Like you can do something now that in the future, like we've seen, will have drastic implications that weren't necessarily modeled or thought about when they were first sort of thought up and implemented.
Yeah.
So.
I think it was just yesterday, and I came across an article yesterday, and I think Congress was drilling the Fed, and they were saying, what sort of stress tests were you running? And it turns out that they only ran like inflation rising up to 1% and nothing above that. Like, are you serious? Like, yeah. How can you not fathom a scenario of inflation running up to 10%? Even like, were you not just curious at one point, right? So I don't think that anyone was thinking beyond. I don't know why, but I don't believe that occurred or had been thought of. But, 2 Thursdays ago, I definitely, a lot of people saw their lives flash, in front of their eyes. I've been bankrolled by SVB indirectly my entire career. So I've been indirectly dependent on them. And also I have friends who are funded indirectly by SVB. My clients are, and I was just at first tackling, moving treasury off of SVB and just thinking about how this can really impact the economy. I mean, it was a really scary night, and just wondering how systemic this issue is. I don't know if this is a deferral of what had occurred back in 2008. And we're reaping we have the opportunity to reap what we sow right now, or we can continue to defer it. I mean, there's just so many things going on in the economy right now. I don't know if we're even aware of where we want to head. We probably don't want to face the issues that we caused back in 2008, but here's the opportunity presenting itself now, and we're going to see more stress in our economy. Honestly, and stress to the startups. I was really sad 2 Thursdays ago just thinking about the all the startups and them losing liquidity, them not being able to find more funding. Banks definitely won't be loaning out money to startups, and so it's a serious issue for sure.
I do have a little bit of concern. I think every good CFO or rent a CFO at a startup or a VC or something should have some concerns about what they do. Your long-term money, the money you're not going to touch for a while, assuming you may not touch it, you park it. There are lots of ways if that part of your balance sheet exceeds $250,000 that you can spread it around. There's a program called CDARS where you can literally use CDARS to find placement of your deposits in CDs so that it gets spread around among a number of institutions so that no account at any single one of those institutions exceeds $250,000. There's ways in which, and I say this to startups because I think it's important that CFOs or people who function as a CFO at a startup should be, and I know Ivan does this, okay, should be thinking intently about, even with their short-term money, finding other ways to put their deposits in more than one bank if it exceeds 250,000.
Yes.
So the 250,000, how is that common knowledge to all founders that you deal with? Because
Yes,
from this, okay,
it's common.
when I learned through
It,
that,
it,
they all
What's
said that-
less common is what Joe's talking about, or what's like knowledge about what Joe's talking about. There are essentially companies that will partner with financial institutions where you'll deposit, say, like $1 million, and they'll take that deposit of $1 million and spread it across, let's say, 4 banks or more, so that each of those institutions provides you that $250,000 coverage, up to potentially per tax ID, like I've seen as high as like $50 to $100 million. This is not.
That they deposit in, does it?
Yeah. So like, let's say I give you the $1 million, right? You're my banker, and then you essentially take that and put it in other banks, right? Opening accounts there on my behalf, essentially.
Now that may not have been apparent to all those East Indian startups who were using Silicon Valley Bank as their bank because they had a relationship where they had a SaaS arrangement, a software as a service arrangement with a Silicon Valley firm, and they were a startup in India, and they were basically just told by their SaaS relationship, oh, use Silicon Valley Bank, they're my banker. Okay, so they may not have known that. Okay,
But it's a moot point now because now
It's a moot point.
all deposits at SVB and banks that are large enough to not be allowed to, or essentially get rubber stamped by the feds, and they'll save even uninsured deposits. Like,
yeah, well, that's not, I want to clarify that a little bit because that's not exactly true yet. The implication has been put out there by Janet Yellen of a guarantee, but they're still researching the mechanism of whether they can do that or not. We had a tag program where all uninsured deposits that were demand deposit accounts during the financial crisis of 2008 that didn't pay interest, they were non-interest bearing accounts, your typical checking account, okay? They were all covered regardless of the amount of deposits you had in the account. They were all covered under the tag program. That expired. So they're researching right now, furiously researching whether or not they can use the COVID bill, the CARES Act, a provision in there to do that without having to go to Congress and get congressional authority to do that. I can tell you, we have a divided Congress. There are a lot of people on the Republican side of both houses. And maybe some Democrats, but I doubt it. But there are a lot of Republicans who are against the idea of uniform, universal deposit insurance. McHenry, Congressman McHenry, is the head of the House Financial Services Committee. He controls what bill actually gets marked up or ever goes to the floor. McHenry has expressed in the last few days he has serious concerns about that. So unless you get McHenry's approval, There's nothing going to happen with that. They're going to have to find some authority, maybe under the CARES Act, to allow for this. So despite the implication that they're going to do this, they're going to actually have to declare the bank systemic in order to be able to exercise that authority, or they're going to have to do something under the CARES Act in order to make it universal insurance. So they floated this idea, but I have to be careful. I do not believe yet that has been worked out. Okay, let's hope we don't have another failure to test whether that's going to happen or not, because there is no agreement there. Okay, and the Fed's trying furiously to find the legal authority to do that, because the tag program that existed under the 2008 crisis has expired.
Where the conversations led us has made me think about this regarding like bank nationalization, right? And so, for anybody who is, either has family from an emerging country or has seen this in like socialistic countries, you see businesses and banks get nationalized all the time. And I'm curious, is the Fed coming in, is this the US version of nationalizing a bank?
Well, okay. So what I would say is a lot of industry. So in the US, we have this really big problem where as an industry matures, it typically concentrates. There's fewer and fewer places, or fewer firms in each industry that control more and more market share, and they become sort of systematically important. Banking is no different. And when you see smaller banks that fail or are allowed to fail, their deposits are often taken over by larger institutions, which just kind of perpetuates the whole problem. And we continue to have sort of systematically important banks, which is just another way of saying, like, we're going to save them no matter what, right? Like, they have essentially welfare or like a social safety net because they're so big that life as we know it financially would be over. So in a sense, we've nationalized them, or basically said, if they get to the point where they fail, we'll come in and save them. And it's us that bears the cost at the end of the day.
Yeah. How many people here believe that the banks were already nationalized back in 2008? I'm certainly one of those believers. Yeah. I mean, like, sure, they're quasi-privatized, but we bailed them out back in 2008. I mean, the people who here sitting in this room don't have any say in how they operate. The government does. But yeah, they were reporting back to the government for many years, maybe still till today. And they are now classified as, or they have been classified for many years since then, as a globally systemic important bank. And now we're seeing that sort of consolidation happening again, where these community banks are unsustainable because the banks were like telling them, the globally systemic important banks were telling them, hey, like, offer these products, we got your back, blah, blah, blah. And then turns out they don't have their back anymore, and they have to liquidate their assets, and they're taking a loss on their profit and loss statement. So yeah, we're seeing this consolidation again. And I think overall what the the Federal Reserve did back last Friday, I think they did the right thing, protecting the customer deposits and giving them back to them. But overall, like, we also need to protect the small businesses and startups, and also like new technology as well, like crypto and Web3. So how do we do that? Do we now report to the nationalized banks again now? How are things going to play out?
And the solutions to all this are just going to sow future problems. So what you were saying.
Yeah. I do want to say that this has been going on for a long time. I basically started my professional career in the first few years of my professional career watching the S&L crisis. Entire thrift industry.
Is that a TV show? Or?
No. Yeah, it's been a long time, Ivan. But during the savings and loan crisis, basically it killed what was called the savings and loan industry, which was a good little industry. It was charged basically with taking mom and pop deposits for savings and then lending it out for residential construction or when someone wanted to buy a home. It was a great system. It was brick and mortar, worked very well. And then basically the federal government allowed the the money market funds created by Wall Street, the MMFs, which was created, the algorithm for that was created by Lehman Brothers, actually. But anyway, one thing or another, that the S&L crisis, some of which was the fault of the federal government in terms of some of their policies, actually, in effect, destroyed the S&L industry. That was a huge constant, you know, it used to be deposits were very, very widely spread out among a lot of banks. There were like 10,000 banks. Then after the S&L crisis, we went down to about 6,000 institutions.
What's interesting about the S&L crisis, though, and in the moment, I just thought it was so weird. Like, I just kept hearing, like, City of Oakland is going bankrupt, City of, Orange County is going bankrupt. Like, do you have any thoughts on that? It just seems so, looking back on it now, it just seems like it was such an insidious crisis. And how did we allow that to happen? I mean, how do governments, municipal cities go bankrupt?
We felt sorry for the S&Ls, and so what we did is we increased deposit insurance from 40,000 to 100,000. Then we expanded their authority to allow them to do commercial lending. They had no background in doing commercial lending, so you had people flying in with Learjets, trying to basically as loan brokers, et cetera. There was a bunch of problems, et cetera, associated with that. And then basically we started to see a failure. But there was also an asset liability mismatch in interest rates. This short-term, long-term investment that I'm talking about between short bonds and whatever, that was also occurring at the same time. There are a lot of parallels between the S&L crisis, this little one going on now in a little way, in a little way. So basically the only point that I wanted to make here is that you had this huge concentration that occurred by basically going down from 10,000, to about 6,000 banks. Okay, fast forward to the financial crisis of 2008, you had a huge concentration that occurred there. Failures of banks, and in addition, I know because I was the chief enforcement lawyer at DFI, Washington Department of Financial Institutions at the time. I closed 18 banks in the state of Washington. Okay. And there were huge credit risks because we had the largest concentration of asset development and construction lending in the United States. And some of our state charter banks were doing that. Some of them, it wasn't even their fault. They were encouraged to buy Fannie Mae and Freddie Mac stock. They had that on their books. They were encouraged to buy things called hybrid securities called trust preferred stock. All kinds of things like that. In some cases, it wasn't the fault of the banks that I closed, and they got caught they didn't cause the crisis. They got caught in a huge credit crunch that wasn't their problem. So what we did is we created a system whereby we had these too big to fail banks. Okay. First of all, we automatically told all the big surviving players on Wall Street that they were now national bank holding companies. They didn't volunteer to do that. They were told that they were now national bank holding companies. Then we made all of them too big to fail.
Because they were nationalized.
Kind of. And the ultimate point where I totally agree with Renata here is that I'll fast forward and just say that we're at the point where I would say banking is like a public utility. Yeah. Okay. I mean, just look at all the non-depository fintechs who do basically all the fun stuff that banking used to be. And they basically just use a rent charter by way of a bank charter on the back end. We've got tons that do that. But basically bank charters now they're very heavily regulated, and they become really more like public utilities. Okay. So to Renata's point, that is a form of nationalization. Okay. I would defend what she said on that, basically from that standpoint. Okay.
But does regulation even have any meaning now that we're just seeing these systemic issues arising again? I think we should start thinking now about how we can bring tools to the public on how they can help themselves self-custody their own assets. And I think that's where crypto steps in. So I'm, in a way, I'm wondering if this crowd is even surprised that this had happened. I think people who have been interested in crypto for a long time have kind of been suspecting this to happen. It was just a matter of when it was going to happen and what do we do from here.
Yeah, I mean, if you just look at the Genesis block for Bitcoin, like in the header, it basically calls out a Financial Times article where it says like Chancellor of the Exchequer, which is like essentially the equivalent of Jerome Powell of the Fed in the UK, is like saving banks or bailing out banks. And like we've just come full circle to essentially where we were back when even Bitcoin was created, and the rationale or reasoning for why. More decentralization, less concentrated power in fewer hands. And it seems like regulation pushes us towards more centralization, and blockchain and other technologies like that will be helpful in hopefully decoupling that. And I think that's what we need.
Yeah. So I do want to get into the crypto side of things. Before we do that, I want to get into the collusion side of things. Which one thing I haven't heard us talk much about
conspiracy
yet was
theories? Love that.
yeah,
That's a lot of fun.
Become reality is how executives at Silicon Valley Bank were selling stocks, their interest essentially before there was the run essentially, and so clearly that typically is a sign of having some sort of information ahead of time. So just curious on your thoughts on those actions. Were they by coincidence or was it more strategic?
I guess the one thing I'll say is typically executives of like publicly traded companies will have plans in place for when they can sell stock, how much, all that kind of stuff. And this is sort of like pre-planned out so that they can't do what you're sort of alluding to. But those plans have an immense amount of flexibility in them. And I suspect the executives were probably operating with the best information. So it's a little uncanny, their timing, but it could just be coincidence.
Well, I don't know. We've yet to see. The CEO, Greg Becker, was on the board of the Federal Reserve Bank of San Francisco. He was actually on its board. There have been calls for complete clawback of everything. And I think that's in order. The question I have is the amount of inside tipping that occurred. I don't think the SEC should let go of any of that. How did Peter Thiel, how did he know this? The information that he gave out, which precipitated the actual run when he told everybody to get out, his fellow VC friends. That's very curious to me, and how he would be able to get away with that. Okay, now he's very powerful. I mean, he's next to Zuckerberg. He's the largest shareholder of Facebook. And he was part of the original PayPal mafia with Elon Musk. He's a very powerful guy, as most of you know. And so the question is, what the heck's going on? He's also a very sophisticated guy. But I think there are going to be some probes. And I think that there are going to be some people that answer for that. And if Martha Stewart can go to prison, I mean, my God, this has got to be something that there should be criminal charges for in some way, shape, or form.
Yeah, quoting back to what I said about I don't know if regulation has any meaning anymore, it means a lot to me because I'm somebody who quotes regulation almost every day. And so from my perspective, it's just like, I think what we've seen with Gary Gensler and his relationship with FTX, I think we're just seeing regulators who are more so opportunists, and they're morally bankrupt and they're capitalizing on these opportunities, or they've created these environments for themselves. That's just kind of my conspiracy theory there, and it's disappointing to see it from that perspective. And I hope that we make a lot of changes so that we can push forward and actually build a sustainable economy that's not hollow anymore.
Yeah, well, I don't think so. Going back to the crypto side, I don't think it's any coincidence that this all happens and we get a run in Bitcoin, right? I think we're like at 28,000 right now.
Yeah.
And it's basically what Bitcoiners say is kind of coming to fruition right now, right? So just curious what you all think about that and the direct relation to, I call it like this crisis leading into that, which, you could say that the other quote unquote crisis that have happened over the last year have been specifically in crypto. So then there's been like this negative impact in crypto. But also when SVB was originally happening, that drove all crypto down, right? And then when the Fed came in, then Bitcoin has kind of just took off from there and gone higher. So I'd just love to hear all your thoughts on is this the time where we decouple, or it depegs from how the traditional financial system has been working? Are we there yet?
I mean, I've renewed my Bitcoin vows, so for sure. Not financial advice. I think I'm supposed to say that at some point. Yeah, no, that's a good point. Like so in investing, whether it's a stock or cryptocurrency or what have you, a lot of these things also move on narrative. Like their prices move on narrative, and that narrative will change over time. For Bitcoin, you've probably heard things like, oh, it's digital gold, so people are trying to price it or value it in relation to gold. Or it's an alternative to the financial system, so when banks are going down, this should go up. It's an inflation hedge because there's only a certain amount, so there's sort of scarcity. And so I think right now, part of the sort of decoupling that you mentioned, like Bitcoin is the play and has been the play that's sort of like the anti-bank. And so it could be rallying as a result of that narrative. And that narrative will change over time, for the good or worse, right? It just depends. So, yeah.
We still need the tools for mass adoption. I would like to say the decoupling will happen soon, but I think the general public don't really understand how to self-custody their funds. So this is why I'm making a huge commitment to support only builders in what I do in my trade of Web3. So yeah, we'll see that happen. I think the general public has a general sense of like, hey, my money's not safe anywhere, and where can I put it? Gold, silver, this thing called Bitcoin, whatever that is, or Shiba, Doge. But I think we're going to start seeing more and more people spread out their savings. I don't think that they're really comfortable with investing at the moment, so we'll definitely see probably slow down in the economy from that perspective as well. And there's just like so many other factors that's happening at the moment, but this year decoupling probably not, but within the next 5 years maybe.
Well, the crypto revolution began with one person, or maybe several people, Satoshi Nakamoto, who basically, if you actually read the white paper, had a fundamental shall we say skepticism about the Federal Reserve and central banks. I think that is that has what drew me to crypto in the first place. I saw deep problems with the Federal Reserve system. They've only accelerated. I think we've reached an inflection point in which there needs to be a massive overhaul. If we're going to keep central banks, there needs to be a massive overhaul of at least the United States Federal Reserve system at this point. We've had several crises. Every time, the Federal Reserve is responsible for every recession we've ever had. At some point, they are a cause. I mean, it wasn't the Smoot-Hawley Act. It wasn't their gold hoarding was some of it, but a lot of the Great Depression can be, and the stock market crash and everything can be placed squarely at the foot of the Federal Reserve Bank back in the 20s that was doing quantitative easing in massive amounts during the Roaring 20s. Then when the Hoover administration came around, they jerked the interest rates up real suddenly, just like they've done here. Okay. They didn't have any tools back then. Okay. There was no deposit insurance, et cetera. So it was massive things that had to be done during Roosevelt's New Deal. But every time you go to one of these crises, you can see that the Federal Reserve is a contributing cause to the actual crisis that they were designed to protect against. Okay, so you have to ask yourself, now that we're in 2023, we've got a new one of these things. We possibly can get out of this one. We've got a lot of Fed facility tools in place, etc. But we're not going to be any better off when we get out of it. Okay, so we have to take a serious look at that. Okay, so I am a little slightly encouraged by Elizabeth Warren and Rick Scott, in bipartisan, believe it or not, for different reasons, just put up a bill yesterday or today that would actually, for the first time ever, create an independent inspector general for the Fed and the CFPB, which operates off of the Fed's balance sheet. Okay, that's the Consumer Financial Protection Bureau, the way that was created during the financial crisis. But so you're saying, oh, that's nothing, independent inspector general. Well, the fact of the matter is, it's a step, because some of you libertarians out there have said, well, Rand Paul and Ron Paul, his dad's figure, said, audit the Fed, audit the Fed. Well, the fact of the matter is, creating an independent inspector general that answers to Congress and not to the Federal Reserve Board. That's this bill. And to get Elizabeth Warren and Rick Scott on opposite sides of the aisle to agree on anything and reach common ground on that. So that bill, that's a step in the right direction. If we get a true audit, answerable to Congress by an independent inspector general, we can begin the process of seeing, do we want to replace the Fed with something? Okay. I do like DeFi. I do like the principles behind crypto very, very much. That's what's always intrigued me about it. That's what led me from being a TradFi banking lawyer to actually moving in the direction of dealing in this area. But I would love to see, on a strictly practical matter, because we have a government, as dysfunctional it is, that we have to deal with, where I see a step in the right direction. If you could get that bill passed, and it's not just a song and dance show. Okay, we could begin to start doing an independent audit of the Fed and see what we can come up with, because they're deep inside that temple, and it's called a temple. There's a lot of things that that have not been looked at and are in the shadows. So I wanted to mention that there's something afoot in that area, and we should encourage that.
I'm so cynical. I wouldn't be surprised if this inspector general turns out to have been bankrolled by Chase 10 years from now when we find out. I mean, Elizabeth Warren broke my heart many years ago. I even have a signed book from her sitting on my bookshelf right now. So,
we'll see. Okay, you may inevitably.
I mean, we can't even do an independent audit of what we're spending in Ukraine right now.
Sure.
So.
Sure.
Pension funds. So that's good.
You may inevitably be right, but look, I want this system to survive.
Me too.
We have a very deep problem with evil competitors in the world.
Absolutely.
Clear enemies of the United States, and we do not need to have a financial system that's in disarray, because that's actual national security weakness.
Well, I want to open up the floor to 2 questions. Does anybody have a question? Go ahead.
That's kind of a 2-parter. What do you think about the CMBS sitting on banks' books? And then, did you find it interesting that a week ago the Fed announced the rollout of Fed Now, timing with all this?
Can you restate what the question was for those listening?
So, I didn't get
the commercial mortgage.
Yeah, commercial mortgage-backed securities,
which small and regional banks, from the data I've been seeing, hold a very large proportion of those. That with everything that's going on.
Mm-hmm.
Yeah.
What are your thoughts on
I'll
You
talk to
start.
the second part of your question about FedNow. I thought that the timing could have been better on the announcement of that, because now it just has all the crypto degens thinking that there's a conspiracy. But yeah, the Silvergate Exchange Network, SEN, that's offline. And then Signature Bank's Signet will soon be offline, and I think is no longer supported by Circle. And these two systems were permissioned or private blockchains that were used by like a lot of Web3 companies, but OTC desks, market makers, exchanges, to move funds between them in a 24/7, 365 capacity. So those have been effectively shut down. So one of the biggest concerns in the industry is like, okay, this is one of the ways people were getting fiat into crypto sort of in mass, at least at the institutional level.
Sure.
So there isn't any other system that I know of like these that's in existence within the US. There are some overseas. So FedWire is kind of like an alternative to that. It's the government version of that that's been, I mean, they've been working on that for years, right?
Sure.
And there's been massive delays, and they choose to announce that it's coming out right after essentially the two competitors of it, private competitors, went out. So it's curious, yeah,
Sure.
for sure.
Well, I know that SVB was planning on implementing FedNow, but yeah, there are international competitors. I think that we do need a solution here in the United States where we can send instant ACHs.
I can speak to both. I've been troubled by concentrations in commercial mortgage-backed securities for quite some time. Okay, the financial crisis of 2008, there was an awful lot of concentration of acquisition, development, and construction lending. Okay, huge concentration. So when construction lenders couldn't find takeouts because the residential mortgages, the spec construction builders, couldn't find anybody to buy their homes because folks weren't getting financing anymore because of what was developing in the residential mortgage. You had this huge problem. And so then from a credit concentration point of view, risk concentration point of view, acquisition, development, and construction lenders, which were mostly community banks, frankly. That's why I closed 14 of them, which were heavily that problem in Washington State. Now with commercial mortgage-backed securities, that can become that could become an equally difficult problem. I haven't scoped out the numbers or taken a look at those numbers in the last year, so I can't speak specifically to that, but I think you flagged a serious issue. Now, as to FedNow. FedNow has been in the works for quite some time. It really has. It's been in the works for at least 6 years that I know of. I've heard about FedNow. You know, the Fed has been operating as a payment system as between banks in the United States since the creation of the Federal Reserve Act, since 2014. They used to do it by telegraph wire. Okay, there would be telegram messages that would go, okay, et cetera. And the Fed was the one to create the first check clearing system. And then they migrated over the years to developing the Miker line, the little uniform Miker line is that. Then they're every little thing that you don't think is tech, but is a tech evolution in some way, shape, or form in terms of delivering payments, the Fed has been responsible for in some way, shape, or form. There is a rival. The rival is the clearinghouse. The clearinghouse consists of the largest 48 banks in the world. Okay. Traditionally, what they did is it was one giant, the Fed has always been gross settlement, okay, on a transaction by transaction basis. Batching or net settlement was what the clearinghouse did. They had a way of netting out each of the 48 banks that were members of the clearinghouse in New York, which had been in business since 1857. Okay, so the clearinghouse, by the way, basically got ahead of this FedNow project with what is called real-time payments, or RTP. and they were offering gross settlement using a back-end blockchain system that had some blockchain elements that is actually an instantaneous kind of thing. And they were marketing RTP, and we're beginning finally to get some traction outside their 48 largest bank members, okay, on a gross settlement basis. So there was a competition between FedNow and RTP, et cetera, and FedNow doesn't want to lose its hegemony to the private sector, which does raise the issue of the Fed is scared to death of crypto. Okay.
They should be.
And they're also scared of RTP, which is not on the surface a crypto thing. Okay. They always have been. The Fed doesn't want to lose its hegemony over the payment system. And so while they were really asleep at the wheel for a while on that FedNow project, they were eventually going to want to catch up because they had been doing this. They were the glue. You want to be part of the payment system? You've got to get a Fed Master account. Okay? You don't have a Fed Master account, just ask Caitlin Long, Custodia Bank. You don't have a Fed Master account, you're not in the payment system. The Fed does not want to lose its hegemony over payments. Okay? That's the key.
Not to mention what BRICS are doing.
Yeah.
Right? There's a lot of threat coming on
Oh, yeah.
for that for sure. It's hard. It's kind of hard to see how it rise.
Yeah, I mean, we're like I said, we're really at a historical inflection point. Okay.
All right, one last question.
So you kind of just answered my question, but this cartel of banks that we call the Fed that have been causing boom and busts for 90 years.
Yeah.
I think it really, excuse me, is and should be scared of crypto. I've been looking for them, and I haven't really seen any attacks on crypto from the Fed.
Oh,
You mentioned earlier, and that this is another conspiracy theory that's been floating around of the Fed's actively attacking crypto banks right now. I didn't really give much merit to that, but you mentioned that all of these Fed banks or adjacent banks are being restricted from taking crypto
company deposits. That's correct.
Why is that?
Well, they used to go around basically when they had made no pronouncements. This is the Fed. This is also not the OCC under Brian Brooks. He liked crypto. Okay, but let's step back a bit and let's say the FDIC at least and the Fed were passively aggressively in telling their banks that they were examining when they come out to examine them. They were saying, yeah, that's kind of risky. They weren't telling them exactly. There was no policy statement officially on the books about it, but they were passively sort of discouraging that, such that there were very, very few banks that you don't want to, I don't want to swear here, but you don't want to anger your regulator. You don't want to anger your regulator because they might give you a bad grade. Those confidential safety and soundness examination scores. You don't want that to happen. You don't want to be put under some kind of C&D. You don't want to become put under some kind of supervisory order that limits what you can do. So what you do is you basically decide it's not worth fighting the Fed on. Okay.
Don't fight the Fed.
Or it's not worth fighting the FDIC on. Even if your state regulator is kind of gung-ho on innovation and technology, you don't want to fight your federal counterpart regulator. And so what you do is you shut it. There were a few banks that were willing to take that risk. Okay. And they took that risk, and then they were accused of concentration risk. Okay. So the Fed created the situation that literally created the concentration risk by making sure that crypto deposits wouldn't be spread out in a way where that was diversified, etc. And so that's your problem here. Okay. And now, as of last August, they came out with a big policy statement. It was joint, the Fed, the FDIC and the OCCC basically saying the standards by which you could engage in any crypto-related activity. Okay. And that included taking crypto deposits. And you had to ask permission from your federal counterpart regulator to be able to do that. Now, fast forward, they made another statement. And now the White House, in its financial stability report, came out just, in the last week and basically said they're totally, really against crypto at all. Okay, I beg all of you to read that. Okay, so it's clear that there's a few banks still doing it. Okay, you can find them, but they're shoving it offshore.
And generally, they've been state chartered banks that have been more entrepreneurial rather than the money center banks. And big money center banks, you couldn't even get a bank account at. Like, it's funny to see a lot of people like on Twitter or whatever that are investors. They're like, go open bank accounts like to crypto companies at these big money center banks. I was like, have you ever tried?
Oh,
I'm like, it's not that easy.
It's not going to happen.
Yeah, it's not going to happen. And if you're able to get a bank account, it's probably not there. It's at a state chartered bank.
All right. And so one more thing, because I want to make a plug for Caitlin Long. She goes out, creates the Wyoming Blockchain Initiative. Then she gets the license for the first special purpose depository institution, along with Kraken, to have a true, crypto custody bank, 100% reserve, redemption, the whole 9 yards, the exact way it should be done. Okay, with standards created by for rulemaking created by Promontory, created by that was the former general counsel for the OCC was in on that. So was a whole bunch of other people, which is a division, all done perfectly correct. Okay. And she can't get a master account from the Fed. They're stonewalling her. And you've got to read the literature on this because I wanted to.
Full reserves.
Yes. And she wants 100% reserved. She's doing it exactly the right way. She can't get a master account with the Fed for fiat to crypto on ramp and crypto to fiat off ramp. She can't get it. She needs a master account for that. She's denied that, even though she is a state chartered bank. This flies in the face of everything that the U.S. Constitution was about in terms of federalism. And I'm deeply offended the way that woman has been treated, and that bank's been treated. It's appalling. I hope she takes it all the way up. I hope she wins at the Circuit Court of Appeals. But I hope it goes all the way up to the Supreme Court, and I hope she wins because a precedent needs to be established there. States were laboratories of innovation, and the states are being denied the ability to do that. Okay.
Anything to add?
I think we should end on a positive note. I'd say, yeah, I think there's like a lot of doom and gloom for the last 2 weeks. And I think that I think we're going to see like a boom in the creator economy, which is exciting for me. And I think that crypto will be a huge part of that. So I think crypto will still have relevancy, even though that our government is not a huge fan of it, even though they're also earning a lot of tax revenue off of it too. I see it. I think this is the first time I've ever seen my clients pay huge tax bills. So, I mean, there it goes. But yeah, I mean, like for all of you here, let's continue to push forward. We humans, we create the best products with scarce resources. So I'm really excited to see what we come up with.
Amen.
Yeah. Awesome. Well, let's give our speakers a round of applause. Thank you, everybody, for watching the broadcast. Real quick, where can people get in touch with you? What's the best ways?
You can reach me at joseph@vincent.attorney. That is a top-level domain. .attorney. Joseph@vincent.attorney. I'm also, I post a lot on LinkedIn. You can find me on LinkedIn as well. Okay, and I'm local. I have an office in Tacoma.
Nice. I would say LinkedIn, even though that's not very Web3, and then Telegram at @stably_Ivan.
Telegram for me. I'm Miss Robot. I don't remember if I have a space in between. I'm pretty bad with social networks. And then I'm also on LinkedIn as well. Renata Fairbanks. I'm blonde in my photos, but I swear that was back in November. It's still current to me. So
Awesome. And for all you watching online and also here, make sure that you are on our socials. We're at TF Labs _ on Twitter. We're at Niftmint also on Twitter, and then you can find us on LinkedIn as well. And then who here is in our Telegram? Is everybody here in our Telegram? If you're not in our Telegram, find me afterwards so I can give you the link, or ask your neighbor who's in Telegram. That's probably the best way to know what's happening next. We're going to meet again on April 5th. We're going to be talking about crypto, taxes, and accounting and finance. So we have some folks who are deep on that side of things who will be in attendance. So I definitely encourage you all to come then. So thank you all for being here. We're going to come over here in just a second and take a group